Right now, as we speak, Plug Power stock is trading live at $2.14, actively battling to hold the line amidst a choppy intraday session that has seen it dip roughly 2.7% so far today. We are watching a live fight between the bulls trying to defend the psychological $2 floor and bears who smell blood in the water. The stock opened at $2.21, briefly touched a high of $2.24, and has since been grinding lower, testing the resolve of every single retail holder watching their screen. If you are looking at your trading dashboard, you are seeing a volume of over 28 million shares already traded, indicating that this is not a quiet day. This is a battleground. But here's the thing. If you are just staring at that red percentage sign, you are missing the massive tectonic shift that just happened under the surface. The expectation for Plug Power has always been that it is the government's darling, the chosen one that would ride a wave of Department of Energy loan guarantees to hydrogen supremacy. Investors believed the safety net was the $1.66 billion DOE loan facility. The reality? Plug Power has just flipped the script in a way that shocked the street. They have effectively suspended activities related to that very DOE loan to pivot toward data centers and immediate cash generation. The expectation was, wait for the government check. The reality is, survival mode requires immediate liquidity, and they are selling off electricity rights to get it. This is no longer just a hydrogen story, it is a desperate strategic scramble for capitalization that changes the entire investment thesis. When we zoom in on the charts, the price action we are seeing today at $2.14 is critical. The technicals are screaming caution. We have established a heavy resistance zone right where the stock opened, between $2.21 and $2.24. Every time the price tries to push through that ceiling, sellers step in, likely institutional algorithms programmed to offload risk and smack it back down. If you are trading this on a platform like Interactive Brokers, you can see the order book stacking up on the ask side. The immediate downside risk is the support level at $1.97. If PLUG breaks below $2 decisively, we enter a vacuum where the next real structural support doesn't kick in till around the $1.70. This is high-stakes technical poker. Unlike Apple stock or Nvidia stock, where dips are often aggressively bought by long-term funds, Plug Power trades with a volatility that can wipe out a week's gains in an hour. The beta on this stock is massive, meaning it swings significantly harder than the broader market. For the average investor using Fidelity or Schwab Intelligent Portfolios, this kind of movement can be nauseating. But for the day trader, this volatility is the oxygen they breathe. Let's talk about the retail versus institutional dynamic happening right now. If you look at the sentiment on Robinhood, you often see Plug Power listed among the most popular holdings. There is a deep-seated belief among retail investors that hydrogen is the future of the planet and that Plug is the inevitable winner. However, the institutional data tells a more cautious story. While giants like Vanguard and BlackRock hold significant chunks, the short interest, the number of shares borrowed and sold by people betting the price will drop, remains dangerously high. This creates a coiled spring effect. If positive news drops, we could see a short squeeze, but in the absence of news, that short pressure acts like a lead weight on the price share. Investors who use SoFi Invest or Fidelity mobile app to track their holdings need to understand that you are not just betting on a company. You are betting against a very sophisticated group of hedge funds who are mathematically betting that Plug Power will continue to burn cash faster than it can print revenue. This brings us to the fundamental divergence that is driving today's price action: the cash burn versus the pivot. In their most recent Q3 earnings, the numbers were a mixed bag that confused the market. Revenue came in at $177 million, which was a miss. They didn't sell as much as analysts hoped. However, the earnings per share was a loss of 12 cents, which was actually better than the feared loss of 13 cents. But the real story wasn't the earnings beat, it was the cash flow. Plug Power has been burning cash at a rate that terrified Wall Street for years. Building gigafactories in Rochester and hydrogen plants in Georgia is capital intensive. It costs billions. The expectation was that they would keep borrowing to build. The reality, revealed recently, is that they are pivoting to asset monetization. They announced they are looking to generate over $275 million not by selling hydrogen, but by monetizing their electricity rights and collaborating with data center developers. This is the AI pivot no one saw coming. Data centers, especially those powering NVIDIA stock chips for AI, need massive amounts of power. Plug Power has access to power. By selling that access, they get an immediate cash infusion without the massive capital expenditure of building a new hydrogen plant from scratch. This is why you might see headlines about Plug and data centers appearing on your Fidelity Wealth Management newsfeed. It is a brilliant, albeit desperate move. It bridges the gap. It buys them time. But it also raises a question. Is Plug Power a hydrogen company, or is it becoming a utility broker? The Project Quantum Leap initiative they talk about is essentially corporate speak for we need to stop bleeding money immediately. They have improved their operating cash burn by more than 50% from the prior quarter. That is the metric that matters. If they can get to cash flow positive, the stock at $2.14 is a steal. If they can't, and they have to dilute shareholders again by selling more stock, $2.14 could look expensive. This is the tension. Robinhood users are often looking for the moonshot, but the Fidelity Mutual Funds managers are looking for solvency. Let's pause for a second and look at the broader context of the hydrogen sector. To understand Plug, you have to understand the color spectrum of hydrogen. Most hydrogen used today is gray, made from natural gas, which is dirty. Plug Power is betting everything on green hydrogen, made from water and electricity using a device called an electrolyzer. They make the electrolyzers. This is a profound technology. It is not vaporware. It is real physics. But the market for green hydrogen has been slower to develop than anyone thought. It's the classic chicken and egg problem. Trucking companies won't buy hydrogen trucks because there are no fueling stations. Plug Power tries to build the stations, but it's too expensive to do alone. This is where the government was supposed to step in. The suspension of the DOE loan activities is a signal that the political winds might be shifting, or simply that the terms of the loan were too restrictive for Plug's current nimble strategy. They decided they couldn't wait for the bureaucratic red tape. They needed to move. Comment below, what is your average cost basis on Plug? Are you holding because you believe in the hydrogen future, or are you just waiting for a spike to exit? I want to see where the community stands, bulls or trapped bears. Now, consider the macroeconomic pressures. We are living in an environment where interest rates are not zero anymore. For a company like Apple stock, which sits on a mountain of cash, high interest rates are fine. They earn money on their savings. For a growth company like Plug Power that relies on debt to build factories, high interest rates are poison. Every percentage point increase in rates makes their debt more expensive and hurts their bottom line. This is why you see Plug fall on days when the Federal Reserve sounds hawkish. If you are managing your own individual brokerage account, you need to watch the 10-year Treasury yield. If yields spike, Plug usually drops. It's almost an inverse correlation. Intelligent investors using Schwab Intelligent Portfolios often hedge this risk, but for the direct stockholder, It is pure exposure. Despite the gloom, there are bright spots that the market ignores. The Georgia plant is producing liquid hydrogen. They are hitting record outputs. They recently signed a contract with NASA. Yes, NASA. It's a small contract, about $2.8 million, but the validation is priceless. If their liquid hydrogen is good enough for aerospace, it's good enough for Amazon forklifts. And that is their bread and butter, forklifts. Walmart and Amazon use Plug Power fuel cells in their warehouses. This material handling business is the steady heartbeat of the company. It generates real revenue. The problem is, the stock price is priced for the hydrogen economy explosion, not just for a forklift company. The delta between forklift supplier and global energy giant is what you are paying for